Welcome back to my weekly QQQ trade series. Last week I mentioned I was battling a cold. It's now turned into laryngitis, so please bear with my hoarse voice. Despite that, we've got a lot to cover this week. We'll start by rolling an in-the-money covered call, where I'll need to decide on a strike price. The cash secured put, meanwhile, is safely out of the money, so I'll let it expire today and set up a fresh one. But first, I want to show you something potentially nerve-wracking, a negative number in my account that suggests I'm down over $1,200 in this position. Thanks to my trade log, though, I can show you why that's not the whole story. In fact, with the options income I've accumulated so far, I'm actually up by more than $3,000. This example highlights a core part of my strategy. I view each option contract as part of a broader system that considers the effects of weekly premiums, adjusted cost basis, and both unrealized and realized capital gains on my shares. After this breakdown, we'll make our trades, and then I hope you'll stick around to hear about a new series I'm creating for investors who are starting from scratch in the market. It's a step-by-step guide for opening an account and becoming a shareholder. This might be perfect for the young adults in your life, or as a refresher for anyone wanting to brush up on basic investing concepts. With so much going on, I hope you'll stay for all three parts of today's session. For anyone new here, I'm Patricia Saylor, Managing Partner of Saylor Financial Fundamentals. Now, let's run the numbers and make some trades. Today, QQQ is trading at $513 per share, and I have two options contracts that are about to expire. A put with a strike price of 480 and a covered call with a strike price of 497. So as I promised, the first thing we're going to do is take a look at this negative number right here. This covered call looks like it has lost $1,217.50 in value. Right now, its net liquidity is $1,623 in the negative. So I want to go back and look at the trade log and show you why this number is not a bad number and why I'm not worried about it at all. So let's move over to the trade log. And I did a little math this morning that I want to share with you. Let's go back and find the place at which I was assigned these 100 shares. It happened on August 2nd. I was assigned to buy 100 shares, and I paid $490 a share for them. And they were only worth $450 a share. So that looked like an immediate $4,000 loss, but it really wasn't. And let me show you why. Prior to this assignment, I had sold cash secured puts starting on June 21st. And I brought in income 1, 2, 3, 4, 5, 6 times prior to being assigned to buy these shares. So I added up all of this covered call income, and I did it here. I made $935 or $9.35 a share prior to being assigned to buy these shares. So the assignment was really not as bad an event as it would have been if I had not been rolling these. Then, after I was assigned, I started selling covered calls, and I made $1,593 on the covered calls. So let's take a look at what happened. So I was assigned here, and every week I've sold a call. The first one, I brought in $102. The next week, $103, then $31, $54, $305, and more recently, as the share price has recovered and I've gotten closer to the strike price, the premium from these covered calls has gone up, $305, $345, $248, and last week over $400. The other thing I've done with these covered calls is worked the strike price up. So the first one I sold, I had a strike price of $475, and that was a risk, but it turned out okay. It didn't go in the money. Then I rolled and increased the strike price to $480. And then for the next one, I got it up to $490. So if I had been assigned to sell those shares, I would have sold them for exactly what I paid for them and had this covered call premium on top of it. But I just kept rolling. And by October 4th, I increased the strike price from $490 to $495 and still brought in $305 in premium. And then I rolled it up to, well, I kept it at $495, and then I rolled it to $497, where I've kept it for the last two trades. So let's go back and look at these numbers again. Since I started this campaign, I brought in $935 in premium selling puts. I was assigned to buy the shares, and then I brought in almost $1,600 selling covered calls. And I have increased the strike price from $490 to $497. So if I'm assigned to sell these shares, I make an extra $700 in capital gains. So when you add all of that up, my potential profit on this position is $3,229.46. So I'm not worried about that negative number. Rolling an in the money covered call is a great way to generate income without taking on additional risk. Anyway, it works. So now that we know this, let's go back and actually place the trades for this week. So I'm going back here, and the extrinsic value from this covered call is almost gone. It's less than $20. And so let's look at some possible rolls. I know that it's going to cost me $1,615 to close the current position, the current call. And let's take a look and see if I can find another one that will bring in more cash than that. So if I roll it out 1 week to November 15th and keep the same strike price of $497, I can bring in about $1,700. If I raise it to $498, I probably can't bring in enough premium to roll for a net credit. So I'm going to go out 2 weeks. Let's look at November 22nd. So now if I keep the same strike price, I can definitely roll for a net credit, but I could even increase the strike price by $1 or $2 a share and probably still bring in a net credit. So let's see whether it makes the most sense to keep the current share price or raise the strike price by $2. So this time I'm looking to, let's see, roll from November 8th to November 22nd. Now, if I keep the same strike price, I can bring in at least $246. Let's see what I can do if I raise the strike price $2 a share to $4.99. So if I do that, I can bring in $82 a share, which would give me potentially $200 in capital gains and 82 or $83, maybe even $100 in options premium. So either one of these is a good roll. I'm leaning toward increasing the strike price a little bit, just because I might be able to continue to stay ahead of this. But let me take a look again. So 200 in capital gains plus 85, or sorry, 200 in capital gains plus 85 in options premium, or keeping the same strike price with $230 in options premium. It's kind of a hard choice. Let's look at 498. All right, I'm going to split the difference. I'm going to increase the strike price by $1 and still bring in $159 at least in option premium, and roll it out 14 days. And I'm going to try to get a little more than 159. Let's see if I can get 190. All right, that filled right away. Maybe I should have asked for more. It filled at 199, so let's put it on the spreadsheet. All right, that takes care of the covered call. Now let's make a decision about this cash secured put. The strike price of the put is 480, and it is well out of the money, so I'm going to just leave it alone and let it expire worthless at the end of the day rather than try to roll it. And now let's choose a new strike price for today's cash secured put. I'm going to open it 11/8 and roll it out just 1 week. Not roll it out, but sell one expiring in a week. All right, the premiums are not really very high for the cash secured puts that I'm considering, and I have a general policy to um, not sell a put with a strike price higher than my current open covered call. So since the covered call has a strike price of $4.98, I'll I'll sell a cash secured put 1 week, expiring 1 week earlier with the same strike price, $4.98. Then I can bring in about $60 or $62. This is not great premium, but um, it's at low risk of assignment, and any bit of cash improves the position. So I'll go ahead and sell this one. So it filled at 63. Okay, so there we have it. This was not a really big premium week, but it was fine. I brought in more than 150, no, more than $250 this week, even though one of these positions is a 14-day contract rather than a 7-day contract. So we'll check back in next week and see where things stand. Thanks again for joining me today. If you're new to the stock market or know someone who could use a solid start, my new Starting from Scratch series breaks down investing essentials in a way that's easy to follow. I cover how to open an account, introduce the lingo, and show you how to understand investment choices. No experience needed. Feel free to share it with anyone who's just starting out or watch it yourself for a refresher. I'll link you to the first video here, and I'll see you next week for a QQQ trade update.